Hey guys, today we're going to be talking about self-directed retirement accounts. Peter Thiel, who owns Palantir, he's one of the early investors in PayPal. He started his Roth IRA in 1999 with $2,000 in it. And today, 25 years later, it's worth over $5 billion of tax-free money that he's able to take out when he's 59 and a half years old, tax-free. And in the meantime, continue to invest it as a tax-free piggy bank into all these other different ventures that he's working on. So I want to dive into what he did, how he did it, and how you can do something similar. All right, so there are two different types of retirement accounts. One is a tax-deferred retirement account, like your traditional 401k or a traditional IRA, where you put money in and then it grows and it gets taxed when you take it out. So it allows you to have a deduction this year by contributing money into that account. So if you make $100,000 a year and you put $5,000 into it, now it takes your taxable income to $95,000. That $5,000 in a traditional IRA or a traditional 401k ends up growing and being invested and compounds over time. And then in the future, when you're 59 and a half years old, you can access those funds and you get taxed at that future date. Then I think it was in the 90s, the Roth component came out. So what the Roth allows you to do is pay taxes on that money today, and then it grows in an account tax-free. And so it's not like, you made $100,000, you put $5,000 into a CD or some savings account. As that interest comes in, you pay taxes on that interest, right? So you get taxed on the money when you get paid, and then you get taxed on it again as you earn interest on it. The Roth allows you to invest in a certain retirement vehicle that then can grow tax-free and you take it out tax-free in the future. I heavily prefer a Roth component as opposed to a traditional. Let me ask you this. Do you think you're going to be making more money or less money when you're 60 years old, when you're taking money out of this account? I hope you're worth more and you're making more money when you're 60 years old than you are today. And do you think that the tax brackets in the government, in the United States, right, are going to go up or down by the time we're 60 years old? I'll give you a hint. I don't expect them to come down because the government owes $30 trillion in debt, and the only way that they're going to gain access to that is by taxing us more. I'd rather pay taxes today at hopefully a lower income tax bracket and a lower tax rate than in the future when I'm 60 years old. So I would prefer to invest my money into a Roth. And they have Roth IRAs, there's Roth 401ks, there's different Roth components to different retirement accounts depending on what you have. The other thing to understand about a Roth IRA is that if you make over a certain income amount, you cannot contribute. However, there's kind of a little bit of a loophole where you can invest your money into a traditional IRA and then do a rollover into a Roth IRA. That's, I think, the first bullet point to understand is that the difference between a traditional 401k or a traditional retirement account and a Roth retirement account. The second bullet point that's important to understand is that you don't need to let a financial advisor direct your retirement accounts. There's something called a self-directed trust account where you can put your money with a custodian and then you get to make the decision on what it's invested into. You can do things like buy a rental property inside of your self-directed 401k or your self-directed Roth IRA. And as you invest and that property is owned by your retirement account, all the income comes into that retirement account, cash flow wise and appreciation wise. And then when you sell it and you have big gains, it all goes back into that retirement account, either tax deferred or tax free. And by the way, a self-directed account is not difficult. There's plenty of custodians. I utilize a company called Specialized Trust Services. Contact my girl Amanda. I don't get anything for promoting her.
All right, well, get ready to wake up.
She's an absolute rock star. She's a member of my mastermind. And so I love her. I love what they do. And they're absolute all-stars and move very quickly and swiftly in this space when a lot of other companies are a lot slower. But They're very supportive, very educational, and can help you every step of the way.
All right, yeehaw!
So if you have an old 401k from a different employer, from a past employer, if you have an IRA that is just with a financial advisor of yours and not with your employer, those are accounts that you can then self-direct. And the key here is you can self-direct those into businesses, into real estate, or into alternative investments, as long as you personally do not own more than 49% of that company or of that property. I could actually, if I have less than 49% or less of a business, I can invest my self-directed retirement account into that business. And that is what Peter Thiel did with PayPal. He didn't own more than 49%. Instead of paying him a big salary, multiple six-figure or seven-figure salary, these startup tech companies would attract talent by giving them huge stock options. And so PayPal offered Peter Thiel a huge stock option of being able to come in and buy stock at a very low price that then he could cash in at a later date and let it jump pretty considerably as the value of the company grew. So he took a salary of like $75,000 but had these stock options. And he was able to buy into those stock options with his Roth IRA. So he invested a total of about $1,600 into his PayPal stock. Well, they continued to grow the business and they continued to bring on more venture capital, which eventually in the first 12 months after he had bought in with his Roth IRA, the first 12 months, that value of his stock in his Roth jumped from $1,600 to over $3 million in 12 months. And then in 2002, eBay came in and bought PayPal, and Thiel cashed out his stock back into his Roth IRA in 3 years at $28.5 million, going into his self-directed Roth IRA completely tax-free. Now, if you're an executive who took PayPal to that level and you've created this unicorn and you're in Silicon Valley and there's a lot of other startup companies out there, you become someone who sees those opportunities before anybody else. So he took his Roth IRA and made essentially a venture capital fund out of this Roth IRA and started placing money into all these different tech startups and putting a couple $100,000 up to $500,000, $1 million in all these different places, and allowed it to accumulate and allowed it to grow. And over time, he'd have these big exits and all these funds would be going back into his Roth completely tax-free. And he's not even 60 years old yet. He's not able to capitalize on those funds until I think 2027 is when he turns 59 and a half. But as all those different companies hit and got bought out by private equity or went public IPO, all these funds came back into his Roth IRA. And then eventually he rolled into Palantir and all these other entities that he owns or has up to 49% ownership in. And today, his Roth IRA is valued at over $5 billion. I think Forbes had his net worth at like $2 billion or $2.5 billion like a year ago, not even realizing he had this $5 billion tranche of tax-free money in his Roth IRA. So what does that mean for you? Well, now you have insight that this is even possible, right? I've been in the real estate industry for a long time, and I've seen people utilize Roth IRAs and traditional 401ks and self-direct them. I'm a big believer in the Roth, right? But you can also do this with a traditional 401k or a traditional IRA. But I do believe that all of us should be self-directing our funds. If you have any inkling, if you're on this channel, if you're watching this video, it's because you have a heightened level of investment knowledge, of understanding of investments, of return on investments, and all the other components that come with that. And so you are smart enough and you have enough wherewithal to direct your own investments. Not a lot leaving it up to the stock market, not leaving it up to some financial advisor who gets paid whether your account goes up or down, but taking control over it yourself. And I would highly recommend taking a look at converting your old 401k or your Roth IRA into a self-directed account and then looking for different opportunities. In the real estate side, you can always invest as a into a syndication. If you don't have large dollar amounts, you can invest in a syndication. Maybe you can buy a turnkey rental property. I've seen a lot of people do that. But I would also allocate a couple bucks towards some of these moonshots.
No.
Right? If you know somebody who has a company that has big upside potential, that has the ability, maybe it's a tech company or a software company, to grow, I'd look at that. You don't need the money right now anyways. It's a good allocation of funds of putting a little piece of it over here and seeing if you can get some upside on these big moonshots, and then at the same time, allocate it to some more predictable type investments like buying a turnkey rental property or making a loan out of it or investing into a syndication or something along those lines. So there's a lot of opportunities out there of things that you can look at. If you are interested in doing something like that, hit me up. I have my smart management software also. So this is a software company that I've been developing for the past 2.5 years that we're starting to utilize in our own portfolio. It is an AI-based property management software. And by the way, I've used all of them, right? I've used AppFolio, I've used Yardi, I've used Entrata, I've used Rent Manager, I've used all the different big property management software companies for our own properties, and our management company, or the third-party management companies have used different ones, and we've navigated all of them. And I can assure you that smart management smokes them all. It beats the heck out of all the other management company softwares that are out there right now. And we're starting to utilize it in-house in our own portfolio. Then I'm gonna take it out and bring it to my legacy family members and have some early adopters and them test it out and give us feedback on it. And then we're going to take it out to the general public in early 2025. And so we're growing it. We've already done all the risky part. I've self-funded the entire thing. And my partner is a software developer. He used to work for a massive company out of Cleveland called Rockwell Automation. If you're in the software engineering space of any sort, you've heard of Rockwell. They are the fixers when Disney needs help with something and fixing something in their system. They're the fixers that Tesla calls to come and fix their motherboards. It's who Boeing has worked with as they've faced a lot of issues and have needed some support. It's like Rockwell Automation is like the fixer of all software engineering. And my business partner, who was a big investor of mine in several different projects, was on a fast track to hit top level with them. And he actually left in order to come and link arms full time. And he's like, listen, I wouldn't be doing this if this wasn't a $1 billion opportunity. And so we've been working on this for full time for the past 3 years almost, and are starting to utilize it right now. And it is awesome. It's really, really good. So if you're interested, check out Smart Management. If you want to learn more about it, smartmanagement.com. And you can also follow it on at Smart Management on Instagram. And hit me up if you're interested in taking a look at it, if you're interested in being an early investor in it. I'm not going out to venture capitalists. I'm not doing any of that stuff. If you are in my circle, if you're in real estate specifically, if you can utilize this software because you hate management companies or you're tired of them dropping the ball and you want something that's AI-based that essentially makes the management company show their work, right? Like, hey, you got the answer, or maybe you didn't get the answer. Show your work. How'd you get there? And it's going to expose a lot of bad management companies, and then all the good ones are going to adopt it because it's going to substantially reduce overhead expenses because you don't need as many staff members. It's going to show you where the gaps are in all the expenses and where you're overpaying. It's going to show you where the gaps are in all the income and where you can be increasing the amount of revenue for the property. And it's all about making properties more efficient. When all the other expenses are going up and NOIs are dropping on property level basis for commercial properties, this completely combats that. And it shows you how to increase income, how to reduce expenses, how to scale the NOI, how to reduce the amount of overhead and have immediate exposure and access to data in how your property is performing. We're super pumped up about it. It's something that I've taken my Roth IRA and converted into a self-directed account and invested into that company because I know where it's going. And so if it's something that you're interested in, would love to chat with you. This is for accredited investors only, which means you got to have a net worth of $1 million or more, or make $200,000 as an individual per year, or $300,000 as a married couple filing jointly. So it's only for accredited investors, but hit me up. We're going to be bringing it out and starting to raise some capital this summer, and I expect it to fill up pretty quick just because I have a lot of people in in the network. Ping me on it. Happy to answer any questions, hop on a phone call with you, introduce you to my partner, Brian Fast, on that, and see if we can scale a unicorn together.